Thank you, everybody, for joining us today for the presentation of the Pavilion Flow-Through LP. This offering has been getting a little bit more attention lately as investors have been grappling with uncertainty around inflation, the continued high Canadian tax rates in Canada, and looking for opportunities around electric vehicle batteries and the metal market. To explain the offerings and why investors may consider adding this investment into their portfolio, we have Graham joining us from Excellent Capital, where he is the VP of Business Development. He's been with Excellent for 11 years and working with the Pavilion flow-through throughout that time. He'll be going through a presentation describing what a flow-through, the tax benefits, the investment opportunity, and benefits to investors. And then we're really excited to have Dan Pembleton, the founder of Excellent Capital and the portfolio manager of the Pavilion Fund. He will be here to answer questions around the intended portfolio and his market outlook as we go through the Q&A section. So with that, I'll turn it over to Graham to begin the presentation.
Thank you, Corey, and appreciate the opportunity to present Pavilion and Excellent Capital to everyone today. And just a logistical issue, I am going to turn my camera off just because it saves bandwidth on the internet here, and it tends to make things run a little smoother. So we'll turn it back on near the end. There we go. Pavilion is a natural resource fund in Canada that helps people save money on taxes, diversify into the Canadian resource sector, and shelter taxable income at the same time. There is a couple of pages of forward-looking statements and disclaimers, which I'm not going to read in its entirety, but I will, as normal, this presentation should not be used, and you shouldn't rely upon it as a substitute for independent research or consultation with your advisor, legal or accountants. And the current investment profile of Pavilion Resource Fund and the key points of the offering are potential for above average returns. We've got a long track record to 12 years now, and I think we're on our 18th fund. There is risk reduction and some mitigation due to diversification into a professionally managed portfolio. And it does offer between 100 and 115%, sometimes even a little bit more tax benefit for every dollar invested. And as Corey mentioned, after this 20 or 25-minute presentation, Mr. Pembleton will be on to talk about the macro timing of the resource market as well, which is quite interesting right now. So all great businesses and certainly investment funds need to start with a why. That's what we really believe. I wanted to talk about our company for a second, Excellent Capital Management, which is the name of the firm, and why it was started, why Dan started the company back in 2002, 19 years ago. And really it was to identify niche markets in Canada and elsewhere and design and manage more effective products, more effective and smarter private equity and private investment products, and make them accessible to investors across Canada. So that's really the why the company was founded, the real motive. And Pavilion Resource Fund in particular, which was created and opened in 2008, was really built, and this is Dan's words specifically, because he saw how Canadian resource pioneers were getting and generating hundreds of millions, and in fact billions of dollars in resource-related wealth for themselves. So he created a resource fund that would act as a bit of a blueprint for investors looking to replicate that investment style of these resource pioneers in Canada, with the added benefit of very significant tax deductions and credits along the way. So that's why the fund was started. And why would you consider an investment in Pavilion Fund? It's really an investment vehicle for high income earners that have tax problems. But most importantly, it's a way to diversify into Canadian junior resources, and alongside a very experienced manager that's developed a lot of successful funds and has managed a Pavilion Fund for, as I said, over 11 years now and 18 funds. It's really the only significant tax shelter available to Canadians today. Of course, we have RSPs, TFSAs, and flow-throughs. And the flow-throughs, in fact, are the oldest program of the three in Canada and was started in the mid-1950s. So who can benefit by investing in Pavilion? Really, investors that accumulated large RSP account balances, investors that have a one-time tax issue to solve. That could be maybe the sale of a building or those type of things. Individuals or families that just want to save money on their personal taxes. And really, that's high income earning Canadians that want to lower their average tax rate. And really, and importantly, investors that are looking for diversification, as I mentioned previously, into the Canadian junior resource sector with professional management to diversify their portfolio into these types of commodities. So that's in general who can benefit from the product. So what qualities should you and would you want to look for in any private investment fund? And I've identified 8. And there's probably more, but in my mind, the top 8 things to look for in any investment fund are: number 1, solid management with experience that has a very clear investment thesis or premise, and a definite hold period is nice, as well as a history, a track record and performance. And it's nice if the management fees are aligned with investor interests as well, so that everybody's on the same page and really is taking on the same type of risks. Downside protection is important, risk mitigation, and you'll see how that works with the Pavilion fund. Tax efficiency is important. It's always good to have a tax efficiency in an investment, and Pavilion is very effective tax-wise. And consistent reporting. So solid management with experience. As mentioned, we do have Dan on the call today. And just really quickly, Dan is an MBA CFA, and he founded Excellent Capital in 2002. So again, we're about 19, I guess we're 19 years old now, and to really create proprietary funds, deal with individual managed accounts and structured investments. And when Dan graduated a number of years ago, one of his first gigs was work on the trading floor, actually the Montreal Commodity Exchange. And I mention that because I think that's where he really got the interest and cut his teeth on commodities and trading high volumes of shares. And he's been working in the financial industry as a trader and portfolio manager for over 25 years now. About a decade of that early on was spent with Dominion Securities, which became RBC, Dominion Securities, where he rose to the level of VP of Global Money Markets, handling about a $3.5 billion money market fund. Dan's education is a BA and an MBA, and he's also a CFA. The company is registered, and Dan is registered with the Ontario Security Commission and the other provincial regulators as a portfolio manager, investment fund manager, and commodity trading manager. And of course, there is a team surrounding Dan, including another portfolio manager, Mark Tokar, and various operations people and analysts. So the investment thesis or premise, the main points are that Pavilion funds really differentiate themselves in this field, in this flow-through sector, by seeking absolute return on investors' capital, and not just relying on the tax benefits of the product to provide returns. And that's significant. We really do look at the Pavilion as a basket of shares that just happens to come with the added benefit of tax deductions. And it is a diversified portfolio of small and microcap resource stocks, which can provide better than market returns over measured periods of time. The time frame on the product, the max hold is 5 years, and it won't necessarily go 5 years, but it could. So that's the defined hold period. And that really, what that does, and if you're familiar with any other flow-through products from the past, you would know that this is a bit of a longer time frame than quite frankly all the competition, which are usually around 18 to 24 months. Our 5-year hold really just does 2 things. It gives these resource explorers, and that's what they are, they're out poking holes in the ground. It gives them time to execute their business plans, to hopefully get enough cycles to make a profit and increase their value. It also gives Dan and his team time to manage the product effectively. And we saw how beneficial that could be over the past few years. The junior resource sector in Canada came out recently, just over the past year, from a long bear or down market. And because of our longer hold period, we were able to work our way through that and help the values of the units increase in value when the market changed. We also use oil and gas as well as minerals and mining stocks in the fund to increase the universe of stocks that the team can choose from, and it gives a little better diversification. In fact, the fund can hold minerals, energy, or alternatives in it. Typically, we'll say that base percentage is in minerals. And in fact, this year we'll probably be in the 90% plus range in minerals and mining, and the balance in oil and gas. And that's just by the nature of what's available typically and what Dan likes out there. So the track record performance, well, since its inception, the Pavilion funds have held the #1 position in respect of their unit values and exits more often than any other flow-through fund available in Canada from any source. And that's during some of the most volatile markets, as I mentioned, in recent history. So really, it's been a premier fund in Canada as far as performance. Now, there's no guarantee on performance, obviously, but that's where we have sat historically. I talked about management fees being aligned with investor interests, and what you'll see on the screen there is what's near the bottom is what's called a performance fee. And this is where the general partner earns, and it's in line with investors' interest. The way it works specifically is that the unit values are purchased at $10. We've always been a $10 unit. And the first $11.20 return goes 100% to the investor. So that's a 12% simple return. That's 100% to investors. If and when the fund goes over $11.20, up to $20 a unit, so up to a double in value, it's an 80-20 split, 80% to the investor, and anything over a double is a 60-40 split. And I will say that we have a fund that has exited a number of years ago, or a few years ago, that was well over a double, just so you understand that can happen. That was our 2008 fund, which exited over $23. And we believe that may be the only flow-through fund in Canada that has actually doubled in absolute return for investors. So downside protection and risk mitigate. The product does come with significant tax credits. So there's tax refunds to help mitigate risk and leave less of your capital at risk. Diversification within the portfolio in different commodities, different sectors, as I mentioned. And just as out of interest, a typical portfolio, this year's will likely have around 30 different companies, 30 different stocks in the fund. So there is significant diversification, professional management, and that defined hold period. And we oftentimes talk about, or really always talk about, what we call the Pavilion ladder effect. And this is also helps risk mitigation by spreading the risk over multi-year investments. And the ladder effect simply means purchasing Pavilion on a bit of a program. And we firmly believe in that investors will do significantly better with a product, a flow-through product, if they were to program it out and invest every year for, say, 3, 4, or 5 years in a row. And that diversifies your portfolio into different multiple funds and different resource companies for risk mitigation. And it also can negate maybe some weaker returns on the odd fund by stronger returns on others for an overall better performance and better experience. And significantly, you can use the tax credits or refund that you get for this year's purchase to partially fund next year's purchase. And in fact, for those in the higher marginal tax brackets, and after 2 years of investing, your tax benefit will be enough to probably fund the third year's investment. So that's what we call the ladder effect, or cycling the product. So at year 3, your new investment could be fully funded from past tax benefits. So that's quite significant too. And that can go now for years like that, where you've only really funded the first 2 years. And consistent reporting, we feel that's important. Every year, you will get what's called a T5013. So T5013 tax slip will be prepared and sent to every investor. The majority of the tax benefits are in the first year. So if you're to purchase Pavilion 2021, so this year's fund, in the spring, next spring, you'll get your tax around the end of March, 1st of April, for this year's taxes, for 2021's taxes. And about 95 to 100% of the tax benefit comes in this year. But you do get the tax slip every year that the fund is active. So every year, you will get a T5013, and there will be some smaller deductions typically on every year's tax slip. By the time it's done, usually around 115% tax benefit. So about 100% the first year and a little bit more every year after that. We do two financial statement runs a year, a semi-annual financial statement run and an annual audit financial statement. So twice a year you will get financial statements along with a letter from Dan and the team talking about the market and Pavilion in general and your fund in particular. And we also do quarterly NAV and commentaries provided by the fund manager. How does it work? A little more specifically, how does the Pavilion Resource Fund work? Canadian resource companies, and we all know that Canada is a very rich country in all resources. And Canadian, when the program started, it was really to help these Canadian resource companies fund their drilling activities, to go look for new energy and mineral sources. And these, because they're out, what I call poking holes in the ground, they're not profitable at that point in time. They're spending money, they're not earning money. So they don't need all the government tax deductions on their exploration and development activities that the Canadian government would give them. So they simply flow through all of those tax deductions back to investors who have helped fund their activities. And that's what a flow through does. That's why they call it flow through. So investors simply purchase units in a flow through fund like Pavilion Resource Fund, which then goes out and purchases flow-through shares of Canadian resource companies that are looking to go out and explore or develop. And by the way, these flow-through shares are really identical to the common shares of those companies. They just come with the added benefit of the tax deduction. So they're actually more valuable than the common shares because you do get the tax credits. And these companies simply flow through all of their tax deductions back to the limited partnership, to Pavilion, who flows them all back to you on that T5013 tax slip. So it's just a simple accounting. You hand the tax slip to your accountant and they fill it out and for your credits. So that's how the program works. And this is really just showing the same thing in a different way. You invest in a flow-through fund like Pavilion, you receive your tax credits, and you keep your units for a holding period, which in our case, I mentioned, would be a maximum of 5 years. Could be sooner, but that doesn't necessarily mean that you wait for 5 years to see any monies returned. Our history shows that just really to manage risk and take profit, the team typically sells shares a little bit throughout the year. And once there's enough to make a meaningful distribution, cash will be sent back to investors. We've on average had a cash distribution every year on most funds. This year, we've actually done 2 distributions already to date, one in early March and one about a month ago. Money does get sent back or drip back along the way, but eventually all the remaining shares in the fund would get sold at a certain point in time when, again, Dan and the team feel it's the right time, and the rest of the cash returned to investors. And of major importance to understand here is that all monies received back on a flow-through fund are taxed as capital gain. So that's what we call the transformative nature of investing in flow-through funds. On the tax side of this equation, what you're really doing with a fund like this, on top of diversifying into natural resources, which is very critical, you're also converting income tax payable now this year at your highest rate into a future capital gain, because you do get the tax deductions this year based on your income tax rate. And again, all monies that are sent back over time are taxed as capital gain, which is only half the gain. Half the gain is taxed, or it's half tax basically. So that's how wealth building can happen on a product like this, even just in the tax area. Not to mention the goal of making absolute return on the shares themselves. Now, the main credit on a flow-through fund is called the CEE, or Canadian Exploration Expenses Credit. And that's what I mentioned flows back through to you. So the CEE credit is the main one. And that's 100% credit that reduces your income by the amount you invest. And that's similar to an RRSP. It reduces your income by the investment amount, which obviously reduces your taxes. But in the year 2000, the federal government put a second credit into this space, into the mechanism, and it's called the Mineral Exploration Tax Credit. And it's in accounting terms, it's called an investment tax credit. And that is an additional or second credit of 15% of the total invested in mining. So you can That's where we talk about the potential of getting up to 115% plus in tax benefit on the fund. And again, most of it, around 100%, is in the first year of the benefit, and a little bit every year after that on the tax slip. Now, you can use these deductions. You can use it all the ones that are available on your tax slip, you can use this year to reduce the taxes you pay. And that would be the normal situation, or the most common situation. But it's interesting to note that you don't have to use all of the deductions. You can actually carry them forward for up to 20 years. So it's a very interesting tool to use to manage taxes. You can use all, some, or none of the credits this year, and you can move them forward into future years. And many people do that. It's a kind of an added benefit when we're looking at being in a potential bull market right now as well, where a lot of investors are looking for ways to diversify into natural resources. And Dan will talk about that cycle and where he thinks we are today. So you can invest today. And even if you invested a little bit more than you needed for tax purposes, you can carry some forward. So I've got a real quick example here, and this is from we've got a little tax flow through calculator that I pulled this off of, and it's just showing it. This says Ontario, but it's similar across Canada. It's just that each province has slightly different tax rates. That's the only difference. But they're not at the highest end. They're really not much different anymore. They're all between kind of 50 and 53%. So this example is just showing someone that had a taxable income of 200,000. If they put 20,000 into Pavilion Resource Fund, they would have approximate tax savings, including that federal ITC, that second bonus I talked about. They would have approximate tax savings for this year of around $11,000, leaving about $8,600, as you can see, of capital at risk. So about 11,400 in tax savings, leaving about 8,600 of the 20 grand at risk, because they've received back in tax benefits 11,400. So if the fund were only to return in a few years the $20,000, it didn't go up or down in value, the return after adjusting for capital gains would be about 16,400. So you would pay capital gains tax on the 20,000, leaving about 16,400, and the return on your actual capital at risk after tax is about 90%, and that's if the fund does not go up in value. So you can see how transformative this is. You save a ton in taxes, and even if the fund doesn't go up in value, and the funds can go down, there is risk to this. But for ease of examples, if we just look at a return of what you invested, you can see how significant the return on capital at risk actually is. And that's really the significant risk mitigation part of the product. And I won't go into this. This is just the current highest marginal tax rates in the provinces in Canada. And I think everybody on the call today would agree that they're likely not coming down anytime soon. In fact, there's potential that our tax rates could go up, especially with the money that has been spent throughout the COVID issue. So in summary, I went through 8 points. The solid management with a ton of experience, I think, and a clear investment thesis is really critical. But just to summarize, Pavilion is a tax-advantaged entry point to diversify your portfolio into resources in Canada. And it's designed specifically to provide a return on the invested capital, not just to rely on the tax breaks. And the fund really does highlight excellent capital and Dan's strength. Quite frankly, and experience in commodities and small and micro cap, and the ability of our team to work with various specialists in the community. Now, just as a last logistical point, and it's nearing a deadline, I mentioned a couple times that the unit values are $10 early in the year this year, and to help to assist in raising some early capital so that the team can take advantage of deals out there of some flow-through, some resource company flow-through share deals, and allow the PM to capitalize on some buying opportunities. We did offer up and have offered up a 10% discount on the units until June 30th. So for the next week, or at least 5 or 6 business days, the units are discounted to $9, after which they'll go to $9.50 for a few months, and then to the original $10. All investors, will participate in potential profit. So early capital, we just felt that early capital should receive a bit of a bonus. So there is that as well. And that's the gist of the product. I'm just going to turn there we go, turn that back on again. And I'll send it back over to Corey.
Thank you very much, Graham. That was a really good presentation. I think you explained everything quite well. So now, if anybody has any questions, feel free to type them into the chat or the Q&A, ideally the Q&A, and we'll go through them live here with Dan. I have a couple questions to start things off. So Dan, I understand that we've come out of a bear market in the junior resource space in Canada. Can you speak to your market outlook and what we might expect to happen in the coming years?
Sure. Thanks, Corey. Yeah, correct. We just came out of a significant long bear market, 8 or 9 years. And that happened, it just happened recently. And you can see on the chart there, that's a chart of the TSX Venture, which our fund, we draw a lot of our investments from that index. And you can see we suffered a long bear market. The length of the bear market and the depth of the bear market is actually now a benefit as we head into what's clearly a bull market, but may also be what some people refer to as a commodity super cycle. And a super cycle is really just a commodities bull market, but when you say super cycle, it just refers to the breadth of commodities that participate in it and the size of the price increases and the length of the bull market that ensues. And in order to have, in my mind, a super cycle event or a very strong bull market, it really relies on three conditions primarily. The first one is supply restrictions. And the reason we have, and I believe that condition exists today, and the reason we have supply restrictions is because of the long bear market. When you think about in a bear market, commodity producers are working very hard to really, in many cases, stay in business as their primary commodity price falls. And so what they end up doing is they're cutting costs. They are trying to be more efficient in their mining. And what that ends up doing, one of the costs that they end up cutting is new mine development and exploration and things like that, which maintain future supply, but they don't need to worry about future supply. When you're in a bear market, you need to worry about making your bond payments and things like that. So they end up cutting those expenses. And when you do that for long periods of time, you end up with running into supply constraints down the road. And certainly with a long bear market, we're now running into some supply constraints. And these supply constraints do not get eliminated very quickly when you think about, particularly in mining, that new mines finding deposits and then getting them to the stage where you can actually mine. That can take a minimum of 5 years and often much closer to 10 or more years. So supply does not respond instantaneously at all when they see rising prices. So that's the first condition. I believe that's in place. The second condition is the demand for commodities themselves. Now, certainly in the first part of the pandemic, when everything closed, demand for commodities contracted. As we've seen on the reopening, as that demand has come back, that's also led to increased prices. I think that we'll see even more demand increase, and that will partially be related to just general economic growth. But the other part of it will be a bit of an influence from fiscal stimulus. If you look around the world, many and most countries the governments are looking at how they can stimulate their economies. One of their very favorite go-to stimuli is infrastructure. And infrastructure by its very nature is very commodity intense. So we've got a coordinated effort on the fiscal front around the world with everybody saying we are going to pave as many roads and build as many bridges as we possibly can, and they're all doing it at the same time. So we think that will also lead to increased demand for commodities. And the third one is also the other reaction to the pandemic, and that is monetary debasement. So in order to deal with the economic downturn related to COVID, we saw central banks around the world lower interest rates and increase their quantitative easing programs or start quantitative easing programs. That has the effect of creating a lot more of fiat currencies. Now, all the central banks are basically doing this at the same time, so you may not see that effect so much as one currency versus another because they're both printing currencies as fast as they can. But what you can see and what you do see is that those currencies start to debase against other assets and certainly against hard assets. And the broad commodity sector would in general be considered a hard asset. Maybe the most noticeable headline commodity might be gold or precious metals, but they are all considered hard assets. So we're seeing monetary debasement. And to me, that I believe is the third wind in the sails of a strong and long bull market.
Perfect, Dan. Thank you very much. That really gives us a good perspective on where things are and where you think things might be headed. We did get a question. Is there a method for investors to review the holdings of the fund on an ongoing basis? And this may be one for Graham.
Yeah, the holdings, of course, Dan doesn't talk about what he's buying yet at this point in time, but it's a bit of a blind pool for a number of reasons, obviously. But yeah, after the fund is closed out at the end of December for sales, the first financial statement, of course, that investors receive will have a list of all the resource companies in it. And in fact, the percentages of each one in the fund, et cetera. So they do get to see and can follow that.
Mm-hmm. Thank you. And another question came in. I guess this kind of relates to what you were saying, Graham, but Dan, what would you like the general makeup of the portfolio to be this year?
Sure. I can talk generally about sectors that I like in particular. And I would just say one thing, certainly in the 2 years prior, I had leaned more heavily towards gold and precious metals. And they will still factor significantly in this portfolio, but I'm trimming my allocation to those. And I want to be clear with everybody, it's not because I'm in any way less enthusiastic about gold and precious metals. In fact, in some cases, given where their prices are right now, some of the stocks I look at, I'm more enthusiastic. But what we have is the situation, as I've seen, as I described in the broader bull market and commodities starting out and potentially a super cycle, there are other commodities that have equal or perhaps even greater opportunities ahead of them. And as a portfolio manager, it just makes sense for me if I have 5 different asset classes to choose from, and I am equally expected, relatively equal future expected returns from them, within an envelope, of course. I don't have a crystal ball, but if I expect relatively they're equal on a return expectation basis, then it just makes sense for me to even out my allocation. I would say there is one particular sector that I think is getting very interesting, and that's uranium right now. That is a sector that has been very, very unloved since 2011 Fukushima disaster and was significantly oversupplied for a number of different technical reasons. A lot of that oversupply has been eliminated, and a lot of the standing inventory was also eliminated during 2020 and into 2021. And we're actually heading into a period of undersupply of uranium. And so I like that sector. The other interesting fact to note is that we now, as on a global scale, produce more electricity from uranium now than we did before the Fukushima disaster, keeping in mind that there were over 50 Japanese reactors that were shut down, and about 37 of those are still shut down since then. But we are now actually, on a global basis, producing more electricity from nuclear power. So that shows you how fast that sector is actually growing, and that growth is expected to continue. So I think those conditions make uranium a particularly interesting sector. Also worth noting is that Canada has some of the, or actually not some, has the highest grade uranium deposits on the planet that are known. and is a great place to find and develop uranium resources. So I like that sector. The other sectors that I think are also very interesting have to do with what we call battery metals. Those are lithium, nickel, copper. Those are the mainstay in that area. And obviously, as the electrification of transportation and also battery storage connected to grid, as that expands over the years, those metals are becoming more and more critical and more expensive.
Mm-hmm. Yeah, and you covered a few questions as they were coming in by getting into the EVs. So you mentioned a few particular minerals that you were bullish on. So that was one of the questions, and then focus on lithium and other base metals for EVs. And so you expect the EVs to be a bit of a driver behind metal prices as well. Was that correct?
Yeah, I really do. I think we've now reached or are very close on the cusp of reaching the tipping point with electric vehicles in terms of the cost of the vehicles themselves and the cost of batteries. And if you just look at the announced intentions of the major vehicle producers in the world, the General Motors, the Fords of the world, their lineups are become 50% electric vehicles over the next few years and moving to 80% electric vehicles a few more years after that. And when you see that the available options, when they're dominated just by electric vehicles, that the construction of those are obviously going to dominate. And that's where the new metal demand for transportation is going to come from. So they're going to require 200 pounds of nickel per vehicle. They're going to require many pounds of copper. They require many pounds of lithium, which is very expensive. And the demand, if we go from producing 2 million electric vehicles globally this year to producing 14 million electric vehicles in 7 to 10 years, that just tells you the kind of demand that's going to be flowing into that sector, and we need it. And as an interesting byline, we were early investors in a lithium exploration company, and that's worked out extraordinarily well, as you can imagine. But there exists in Canada other companies that I have my eye on that are very inexpensive and quite overlooked in the lithium space. We certainly are looking at some nickel projects. There's some very prospective copper projects in Canada. Canada is very lucky in that we have virtually every commodity you can think of. It can be found within our borders. And that's going to be very helpful for us over the next few years.
Mm-hmm. That makes sense. And it's good to have a very large country with lots of commodities. Could you speak to Canada relative to the rest of the world? Because you mentioned that we have almost all the commodities that within our border, but are there other major locations that we might be competing against for market share? Are we expecting Canada to be able to supply a lot of this demand into the EV market or into the nuclear reactors as well for uranium?
Yeah. So Canada is, and you mentioned nuclear last there, we're number 2 producer. We have the resources that we have are incredible in the Athabasca Basin. And I certainly believe that as we go forward, and because those resources are so high grade, that it makes us actually a very low cost producer. Kazakhstan is the number 1 producer, and they're obviously a very prolific producer, and they have very low grade. There are certainly other jurisdictions around the world, but Canada is known. All of the major global nuclear exploration and uranium production companies are all represented in the Athabasca Basin. And so we are seen as a global supplier there. On the lithium front, our lithium is hard rock lithium. So that means you have to mine it and break it out of rocks. Other lithium producers, there's other hard rock lithium producers around the world. A lot of lithium is produced from brines. That's a process that can be somewhat weather dependent. environmental impacts are a little bit in question in some jurisdictions. And also our lithium is certainly the one that we've invested in, that we look to invest in, are very low purity ones. So they're excellent for as feedstock for the battery metals themselves. Would have to be highly pure metal, of course, in order to make it into a battery. So we are very lucky, and also from a positioning point of view, we're seen as a favored supplier to the United States, and certainly there's a lot of reason why those companies would look to a shorter supply chain with a very close neighbor. The other thing that's interesting too, and I haven't talked about yet, is the rare earth elements, which made it the news and headlines a lot in the last year, where about 70% of those metals, which are additive to making magnets or screens or very sophisticated sensory equipment in the military, about 70% of those are produced or refined in China. And from a national security point of view, the US wants to change that. Canada's quite rich in rare earth elements as well. So we are fortunate enough to have those, and we are most definitely on their radar screen. And that's an area where I've made investments in the past, and I have a few companies on my list.
All right. Perfect, Dan. Thank you very much. I don't see any other questions, so if anybody has some last minute ones, please type them into the chat. Otherwise, just to sum this up, there are some long-standing tax advantages related to flow-throughs that can be one very good reason to invest in flow-throughs. And this year, Dan, there are a few other kind of wins that are back with this year's investment into flow-through. So are you excited, Dan, about this year, about the prospects of the markets and your outlook relative to some other years in the past?
Yeah, it is an exciting to certainly, and I see it happen every day. Being as was mentioned before, I'm a fairly seasoned trader in markets, and as I see things happening in the market, the investment interest coming in from around the world, all of the different, we've seen some price increases, but certainly these are also extraordinarily low. Although we've seen very good price increases in the funds that we are already operating have performed extraordinarily well, as you can see on that graph, which, by the way, doesn't completely cuts off the old high, which was around 3,600 in 2007. We're really just coming off the bottom. It hasn't really even started, but it's exciting to see people who have invested with me in the past really making a lot of money. It's great to see the trading volumes that are going through the tickers and the amount of interest that's coming into the market. And yeah, so I'm quite excited for the future.
I just wanted to say too that investors really shouldn't, and we don't, let the tax benefits kind of wag the ear, but rather build portfolios of various Canadian resource shares with the goal of absolute return for our clients, with the added benefit of the tax deductions. So I just want to point that out, that this is really driven as a resource fund.
Mm-hmm. Absolutely. A lot of reasons to invest in a resource fund right now. And I really appreciate walking through those, and the additional tax benefit is a great bonus on top of that. So with that, we didn't have any more questions come in. So I just wanted to thank you very much for joining us today. And I hope our investors got a lot out of it. They can feel free to reach out to their private wealth advisor to learn more and answer any, and advisors that may loop back in with Graham and Dan if there are any more complex questions as well. But thank you very much, and enjoy the rest of your week.
Thanks again, Corey.
Thanks, Corey. Bye-bye.